Dear students, today we will be discussing on very important topic, fundamentals of exempted income. As you know, under the Income Tax Act, all incomes unless otherwise stated are fully taxable. Here exempted income, the term means that income which is exempt from tax. It is income, but it is exempt under the Income Tax Act. Under section 10 of the Income Tax Act, there are several sections promulgated under the Income Tax Act 1961, where certain incomes are specifically exempt from tax subject to satisfying certain terms and conditions. So this is the basic of exempted income, means income which are specifically exempt from tax under the Income Tax Act 1961. Section 10(1) is given to agricultural income. As per section 10(1), agricultural income earned by taxpayers in India is totally exempt from tax. Now the question, what is called agricultural income? Under section 2(1)(a), agricultural income means any rent or revenue which is derived from land. The land must be situated in India and land must be used for agricultural purposes. These are the three basic conditions. Besides, any income derived from land by agricultural operation in the processing of agricultural products to render them fit for marketing. Agricultural income may be received either in cash or in kind while collecting from the cultivator. Under the Indian Constitution, the central government has no power to levy tax on agricultural income. However, if agricultural income of a taxpayer exceeds rupees 5,000 in the case of individual, Hindu undivided family, body of individual or any other related persons, it shall be taken into account in determining the tax liability applicable on non-agricultural income by the method of integration. We call it integration or partial integration of agricultural income with non-agricultural income. I will be coming later. Now it is very interesting to mention here that there are some composite income that arise while we go for agricultural processing. As I told just little earlier, that in case of tea, coffee, rubber or other products, it requires a great degree of agricultural processing to make these products to the market. Income from sale of rubber, centrifuged latex processed and derived from rubber plants grown in India by sellers in India. Whatever income arising therefrom, 60% is to be treated as agricultural income and is exempt under Rule 7A. Any sum received by co-personer from Hindu undivided family, section 10(2), if a person which is a member or co-personer of a Hindu undivided family, by virtue of section 10(2), whatever he or she gets from the Hindu undivided family corpus, or in case of impartible estate, whatever amount is received by him out of the family income shall be exempt from tax. In short, whatever income goes to the hand of a co-personer of a Hindu undivided family, it is exempt from tax by virtue of section 10(2). Section 10(2)(a), share of income from firm by partner of a firm or an LLP, limited liability partnership. Under section 10(2)(a), share of profit received by a partner from a firm is exempt from tax in the hands of the recipient taxpayers. Further, share of profits received by a partner of LPP from LPP will also be exempt from tax in the hands of the partner. The exemption is limited to share of profit only and does not in any way consider interest on capital, remuneration, etc., commission, received by a partner from the firm or LLP. In short, it may be highlighted that whatever share of profit a partner received from a firm or LLP, that is exempt, but if any remuneration, commission, interest, etc. received from a firm that are not exempt, that are taxable in the hands of the recipient partner. Then we are coming to the next point, perquisite and allowances given by Government of India to its employees outside serving India. Section 10(7). In fact, under Section 10(7), all allowances and perquisites whichever is paid by Government of India to an employee who is rendering service outside India are exempt. Income of employees of foreign countries working in India under Cooperative Technical Assistance Program, Section 10(8). Under Section 10(8), any income received by an employee of a foreign country while working in India under Cooperative Technical Assistance Programs in connection with an agreement of the Government of India and the government of that foreign state shall be exempt from tax. Now we are coming on to pension. Pension is a very important point of discussion. Section 10(10)(a). Pension means whenever a person retires from a service, after retirement he or she is to get pension from the employer after retirement. This pension is provided some exemptions under Section 10(10)(a). Before that, we must understand that pension receiving by a retired person may be of two types, uncommuted pension and commuted pension. What is uncommuted pension? Uncommuted pension is regular receipt of pension in lieu of pension at a time. That is, regularly every month, every quarter, retired persons get from their employer. This is uncommuted pension. And another part of pension may be, or another type of pension may be commuted pension. That is, instead of regular payment, it is taken lump sum at a time. It is called commuted pension. Then tax treatment of uncommuted pension. Any uncommuted pension is always taxable as salary income, because for rendering service as employee someone is getting this pension. So it is taxable salary irrespective of whether the recipient is a government servant or employee or a non-government employee. In other words, uncommuted pension, whenever it is received by any person, he is government employee or non-government employee, it is always taxable and shall be regarded as income from salary. Now regarding commuted pension. Commuted pension means, already discussed that commuted pension means you are not getting after retirement regular pension, you are getting it at a time, lump sum. In that case, how commuted pension is treated for exemption under Section 10(10)(a). In the case of government employee, that is, if the employee receiving commuted pension being a retired government employee, the entire commuted pension is exempt from tax. If the employee receiving commuted pension and he is not a government employee, in other words, he is a non-government employee, in that case, pension received is taxable as follows. If it is seen that the non-government employee does not receive gratuity at the time of retirement, only he is getting pension, not gratuity, in that case, half of the full value of commuted pension is exempt from tax. That is, whatever pension he is getting, half of that converted into full value will be exempt from tax. And if the non-government employee at the time of retirement gets gratuity also and receiving uncommuted pension, in that case 1/3 of the full value of the commuted pension is exempt from tax. Now family pension. Family pension means pension is received by a family member after the death of the person for which they are getting, that is called family pension. It is to be mentioned here that family pension received by the members of the employee, maybe dependent, recipient or legal heirs, whatever might be, who are entitled to get, they will be getting. But that family pension is fully taxable in the hands of the recipient legal heirs or dependents. Family pension received by members of armed forces in India is totally exempt from tax. Now, gratuity. Section 1010, it is another payment received usually by people after retirement from his employer in recognition of his past services. This is gratuity. Gratuity is actually a voluntary payment or a gratuitous payment made by the employer to his employee for services rendered. Gratuity received by any employee while in service or employment, it is fully taxable. That is, whenever an employee is in service and for reasons whatsoever he is getting gratuity, it is fully taxable. Gratuity received by government employee during the time of retirement of death, that is, whenever an employee who is a government employee, he gets gratuity at the time of retirement or on death, it is fully exempt from tax. Whether the employee, that is government employee, is retiring from a government service or defense service or civil service, etc. But gratuity received by non-government employee is taxable to some extent and to some extent exempt under section 1010. We are considering that. If gratuity is covered under the Payment of Gratuity Act 1972, the list of the following will be exempted. Rupees 20 lakh, amount of actual gratuity received, amount of actual gratuity received, 15 days salary based on last salary drawn by the employee based on his completed year of service. Here, number of days for last salary drawn to complete for 15 days is taken as 26. Number of completed year of service is rounded up to the nearest full year. But if the gratuity is not covered under the Payment of Gratuity Act, then the exemption amount shall be the list of the following: rupees 20 lakh fixed, specified, amount of actual gratuity received, half month's salary based on last salary drawn for every completed year of service. These are the three limits which are exempt, and rest part is taxable. Now, leave encashment, section 1010A. Leave encashment means that is encashment of leave earned by an employee while serving as employee. That is, whenever someone is rendering service, he is to accumulate leave as his power to accumulate. And if the leave so credited to an employee, that can be encashed. But if the leave encashment by an employee is received during service, that is, while he is in service, he is getting any leave salary, that is fully taxable. However, leave encashment after retirement from service or termination of service or death is exempt from tax under section 1010A. In the case of central government employee, the entire receipt of earned leave at his credit at the time of retirement or superannuation or resignation is fully exempt from tax. In case of other employees, that is non-government employees, the exempt part of leave salary or leave encashment is actual amount of leave encashment received by the employee, cash equivalent of earned leave not exceeding 30 days for every completed year of actual service at the credit of the employee on retirement, 10 months average salary during 10 months preceding employment, and rupees 25 lakh. These four items, the list item is exempt and rest part taxable. Receipt of leave encashment or leave salary by the family or legal heirs of the deceased employee is fully exempt from tax. Now, retrenchment compensation, section 1010B, it is also important. Any compensation received by a workman at the time of retrenchment or closure or transfer of undertaking or interruption of service for reasons whatsoever is exempt from tax to the extent of the list of the following under section 10(10)(b), actual amount of retrenchment compensation received by the employee, amount calculated at the rate of 15 days salary for every completed year of service or part thereof in excess of 6 months, and rupees 5 lakh specified amount fixed. These are the three conditions. Where any such compensation is received under a scheme approved by the central government, it shall be fully exempt from tax. It is important. If someone gets compensation, retrenchment compensation as per a scheme approved by the central government, it is fully exempt. Here salary means basic salary as per terms and DA as per terms of employment plus commission on a fixed percent of turnover achieved by the employee. Now this part is very important. People take life insurance policy for future security and safety. Now whenever this life insurance policy is matured, they get an amount, that is the maturity proceed, that is the sum assured plus any bonus accruing thereon. Section 10(10)(d) of the Income Tax Act specifies that any sum received under a life insurance policy, including sum allocated by a bonus on such policy, is wholly exempt from tax subject to certain restrictions. It will be exempt but subject to certain restrictions. However, maturity proceeds, if received on the insured death, it is exempt. That is, if the person on whose life it was insured is dead, then whatever maturity proceed is received by the family members is fully exempt. But whenever the insured person is surviving and after maturity of the LIC policy he gets something regarding original sum assured plus bonus, that is also exempt subject to satisfying certain conditions. What are these? For maturity amount exemption, consider whether the policy were taken before 1st April or after. If the policy issued before 1st April, then the maturity proceed will be exempt from tax under section 10(10)(d) if the premium paid for any year during the policy term does not exceed 20% of the sum assured. Sum assured means the amount guaranteed to be paid to the policy holder on maturity. But if the policy is taken on or after 1st April 2012, in that case maturity proceed will be exempt from tax only if it is seen that the insurance premium paid for the LIC policy did not exceed in any year 10% of the sum assured. For instance, if one's policy sum assured is 10 lakh and the premium paid is not exceeding 1 lakh, then he is eligible to get exemption for maturity procedure. He is eligible to get tax exemption from maturity proceeds. Payment received from Provident Fund, Superannuation Fund, section 10(11), 10(12), 10(13), etc. Payment received from a Provident Fund under the Provident Fund Act or Public Provident Fund Scheme 1968 and from Superannuation Fund is exempt from tax. Interest on accumulated balance in Public Provident Fund STF, that is Statutory Provident Fund, is fully exempt from tax. However, interest on accumulated balance of recognized Provident Fund is exempt up to 9.5% rate, above is taxable. In case of Public Provident Fund and Statutory Provident Fund, whatever the interest on accumulated balance is received is fully exempt from tax. Allowances fully exempt from tax, section 10(14)(1) and 10(14)(2). Special allowances are exempted for specific individuals under section 10(14)(1) and 10(14)(2), such as UNO employees, United Nations Organizations employees, allowance to government employees for rendering services outside India, whether who is an Indian citizen, High Court judges, High Court and Supreme Court judges entitled to receive the sumptuary allowances. Sumptuary allowances means the allowance that is provided to the High Court and Supreme Court judges to provide entertainment to their guests in the court. Conveyance allowance granted to meet the expenditure on conveyance in performance of official duties, daily allowances received by MPs and MLAs, uniform allowance, etc. are exempt from tax under section 1014(1) and 1014(2). Now, allowances partly taxable and partly exempt. House rent allowance exemption, section 1013A, where an employee gets house rent allowance to meet the cost of accommodation of him or her, is exempt from tax to the specific, subject to satisfying specific conditions and limits as provided under Rule 2A. Point 1. Excess of rent paid over 10% of salary, 50% of salary for accommodation taken or situated at Kolkata, Bombay, Delhi, Madras, or 50% of salary for other places where accommodation is taken and situated, actual amount of HRA received. However, this exemption is allowable to an employee only if the employee receives in such a house for which he pays rent, or the employee does not reside in his own house. Here salary means basic salary plus DA or DP if the terms of employment so provide, and also commission on a fixed percentage of turnover achieved by the employee. No other allowances are to be included here. Education allowance, section 1014. Education allowance is sometimes provided by employer to employee for meeting educational expenses of their children, and it is exempt up to 100 per month per child, maximum 2 children. And if in addition to this hostel cost or hostel fees are also provided by employer to employee, then additionally 300 per month per child, maximum 2 children is allowed under section 1014 for getting exemption. However, this deduction is not available under the default tax regime under section 115 BAC. Interest on certain bonds, securities and certificates, deposits, etc. under section 1015. Receipts of interest from investments on capital investment bond, RBI relief bonds, interest on gold deposit bonds 1999, or deposit certificates under gold monetization scheme 2015 are exempt from tax. Receipts of scholarship, section 1016. Any scholarship provided to meet the cost of education, whether given by any central or state government or any authority, is fully exempt from tax. Allowances of MPs and MLAs, section 1017. Daily allowances, constituency allowance, sitting fees as members of parliament or state legislative are exempt from tax. Receipt of gallantry award from government. Whenever a person received any gallantry award like Parambir Chakra, Ashok Chakra, Mahavir Chakra, etc., it is fully exempt from tax. Pension received by awardees of the Parambir Chakra, Mahavir Chakra from government, section 1014. Not only the awardees get gallantry award exempted, even if they get pension, the awardees are Parambir Chakra. Once he got gallantry award and now he is getting pension, in that case under section 1018, receipt of pension by the awardees of Parambir Chakra, Mahavir Chakra, Ashok Chakra, etc. from government, including family pension of such awardees, is totally exempt from tax. Now, income of Khadi and Village Industries Board, section 1023B, 23BB. Income of Khadi and Village Industries Board, including income of a public charitable trust, registered society, etc., engaged in the development of Khadi and Village Industries Board, is fully exempt from tax. Income of European Economic Community, section 1023 BBB. Any income of European Economic Community derived in India by way of interest, dividend or capital gains from investment made out of its fund under such scheme as the central government may notify in this respect is exempt from tax. Income of a SARC fund for regional projects, section 1023 BC. Any income of a fund established by SARC as SARC fund for regional projects such as Colombo Declaration issued on 21st December 1991 by heads of the state or government of the member countries of South Asian Association for Regional Cooperation is exempt from tax. Income of Regulation Authority under section 1023B or income of Prasar Bharati, all are exempt from any income receiving by these two authorities, IRDAI and Prasar Bharati, fully exempt. Income received by a person on behalf of following funds, section 1023. Any income received by any person on behalf of Prime Minister, National Relief Fund, Prime Minister's Fund, Promotion of Folk Art, Prime Minister's Aid to Students Fund, Swachh Bharat Kosh, Clean Ganga Fund, etc. is exempt from tax. Income of notified mutual fund under section 1023D fully exempt. Of Sikkimese individual under section 1026 AAA. The following income which accrues or arises to a Sikkimese individual would be exempt from tax if the income arises from any source within the state of Sikkim or income by way of dividend or interest on securities. However, this exemption shall be disregarded or shall not be available to a Sikkimese woman who marries a non-Sikkimese individual on or after 1st April 2008. Income received or subsidy received by certain boards or authorities under section 1029A, 1030 and 1031. Income including subsidy received by Tea Board, Coffee Board, Rubber Board, Tobacco Board, Spices Board, Coir Board, Marine Products Export Development Authority, Agricultural and Processed Food Products Export Development Authority, etc. is fully exempt from tax. Income of minor when clubbed is to get some exemption under section 1032. In other words, while clubbing minor's income with the income of parent by virtue of section 64(1)(a), a maximum of 1,500 per month per child is exempt under the Income Tax Act for maintenance of the minor. Tax solidity or complete tax exemption to units established in specific economic zones, SEZ, section 10AA. That is, exemption will be available only in respect of export profit arising in the hands of SEZ units. However, the following conditions are to be satisfied under section 10AA. The entrepreneur should enroll within the provision of section 2J of the Special Economic Zone Act 2005. The company should not have established by reallocating previously used plant and machinery. However, in certain cases, SEZ may acquire or purchase second-hand machinery. The SEZ must commence its production or business operation on or after 1st April 2005 and but before 2021. The SEZ unit should not be incorporated by restructuring or splitting of an existing business. The tax exemption from export profits under section 10AA is available if the SEZ unit began its operation on or after 1st April 2005 but before 1st April 2021. The amount of deduction for export profit are available as follows. 100% of the export profit is entitled to get tax holiday, complete tax nil situation for the first 5 consecutive years, that is 1 to 5th year, 1st to 5th year. 50% of the export profit is entitled to tax exemption for the next 5 years, that is 6th through 10th year, and 50% of the export profit or the amount credited to Special Economic Zone Reinvestment Reserve, whichever is lower, is entitled to tax exemption for a further period of 5 years, that is 11th year to 15th year, subject to satisfying certain conditions. Once again, 100% export profit for the first 5 years free, tax holiday complete. 50% of the export profit is provided tax exemption for the next 5 years, that is 10 years, and for the rest 5 years there is some restriction, that is 50% of the export profit or the amount transferred or credited to Special Economic Zone Reinvestment Reserve account, whichever is lower, is entitled to deduction tax exemption under section 10AA for further 5 years, 11 to 15th year, subject to satisfying certain conditions. The amounts credited to SAGE reinvestment reserve has to be utilized or used to purchase new machinery or plant within 3 years from the date of creating or transferring amount to SAGE reinvestment reserve. If the amount in the said reserve is not utilized within 3 years or misutilized, then the amount of exemption claimed earlier shall be added to the profit of the year after the completion of the year or in the year in which this misutilization is done. The export profit available for exemption under section 10AA of a SAGE unit is computed as follows. Export profit is equal to, it is computed by applying this formula, SAGE units total profit divided by total turnover of SAGE unit multiplied by SAGE units export turnover. Here export turnover refers to the amount that a business receives from its export. It does not include any insurance expenses, telecommunication charges, etc. Okay, thank you.